Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to compare REITs and direct property. So REITs is an acronym, REIT, of course, Real Estate Investment Trust. That's what it stands for. And for a long time, I've changed my opinion, over REITs versus direct property. Maybe 20 years ago, I would discount it as a more volatile, less like property asset. There's been times when, over the last 20 years where I've felt that it's had more merit in terms of it's still a different style asset. And, then when I prepared for this episode, I've changed my mind again and, looking at the detail and diving in a bit deeper, I think it has even more limited application than I initially thought. So that's what I want to talk about today, because quite often, when we talk about property as an asset class, we can think that we can invest in it directly, as in own a property, or use ETFs or REITs, actively managed REITs, these sorts of things to access that market. But you really want to make sure you are accessing that market and that investment behaves much like the underlying asset, so that is property. Because often we're obviously comparing or weighing up, should we invest in property or should we invest in shares? They're the two main growth asset classes, of course. And the idea is to hopefully invest in both and achieve some diversification across your portfolio. So I want to talk about REITs today. And of course, I need to define, what we're talking about when we talk about direct property. And I probably don't need to spend too much time on this, given I've spoken a lot about direct property, particularly direct residential property in the podcast. And in fact, I recorded episode 311 where I talked about the 6 key disadvantages of investing in direct property. And I know that's a bit strange because you would expect me to talk about the advantages, which I've recorded many podcasts talking about the advantages. But I think what are some of the reasons why you wouldn't invest in direct property? I think that's got to be a sort of starting point to almost take it off the table rather than put it on the table, on the basis that, there's a lot of businesses out there, buyers agents, social media, all espousing the benefits of property investment. But let's be honest, no asset class is perfect and it has some downsides as well. Some of the attractions, having said that, some of the attractions of investing in direct property, typically control. I think control is one of the main attractions. People like to be in control of their money, their wealth, their future. When you own a property, you can renovate it, you can improve it, you can decide who you want to rent it to, or to a lesser extent today with the tenancy rules, but you've got more control over how you use that asset, which asset you buy, those sorts of things. Whereas with share market investments, of course, we're along for the ride. If you have equity in existing property, we know you can borrow 100% of the cost. So really, you don't have to put any of your own money in initially to the investment, and that gearing and the fact that you don't need to access a lot of savings to to buy an investment property if you have existing property is a huge attraction. And then lastly, negative gearing tax benefits. So we know that we can, if we lose money by borrowing the full cost, we know that the interest cost is going to be considerable and therefore we'll lose money. It's a cash flow cost. We can offset that loss against other income. And so in essence, if you're on the highest marginal tax rate, the federal government's paying for sort of half the holding costs of that asset. And meanwhile, you're keeping 100% of the compounding capital growth. Of course, you've got to pay capital gains tax eventually on that growth, but that's how property is going to work. So I know listeners to the podcast will know lots about property because, as I said, I've spoken about it plenty of times before. But let's spend most of today talking about REITs. As I said, stands for Real Estate Investment Trusts. And these are really they can be listed or unlisted, but we're going to talk about the listed version of REITs. And so these can trade on indexes, share indexes, whether it's overseas or in Australia on the ASX. If it's the ASX, so Australian REITs, they're known as A-REITs. Well, there's no prizes. No one was up late at night trying to come up with that acronym. Of course, it's a pretty obvious one. So what are REITs? Well, there there are some definitions of what companies need to fulfill to be regarded as a REIT. In the US, the company must earn at least 75% of its gross income or revenue from either renting out buildings it owns or mortgage interest. So that is if they issue or lend to property developers or property owners. So really their core business has to be within property. In Australia, there's the slightly different rules. 80% of a REIT's assets must be in the form of real property. So it goes to the assets rather than the income. And they must distribute at least 90% of their net income. So unlike a company like Amazon or whatever it is, that it can retain its profits and reinvest in the business to build the business, a REIT in Australia has to pay out the income. And the whole reason for this is to try and make sure that people are getting what it says on the tin. So if I want to invest in property, let's make sure the balance sheet is mostly property. In Australia or in the US, let's make sure the income is mostly from property. And so really, in essence, a REIT is just a pooled investment vehicles. A company, if you like, or a trust that owns lots of different property, earns income from property, could be lending to the property market. And also, if they own property, they're exposed to changes in property values. In Australia and even overseas, some of the listed REITs are actually unit trusts rather than companies. And that means that the end investor pays the tax on the earnings rather than the company. So in a normal share environment where you're investing in a company, of course, the company pays tax, 30%, and then passes on a dividend to you with some imputation credits. Whereas with REITs, quite often they're trusts, and trusts are flow through vehicles. So the REIT might not actually pay any tax, instead passes all the gross net income onto you, and you as the investor pays the tax. Quite often in Australia, what you'll see is you've got REITs and then you've got the management entity. And investors might have a stake in both those two assets. The management entity might be a company, so that's the entity that kind of manages the portfolio of property. And the REIT is the trust part of that portfolio. It's in a unit trust. Quite often what they do is staple those securities together, which means that you own ostensibly kind of one share in the company and the management company and one share in the REIT. And these are called stapled securities, and they're still traded on the ASX in the same fashion, but those two assets, the share in the trust and company, are inextricably linked. REITs can hold, diversified different types of property, so diversified mix of properties. So that could include, industrial property like very large manufacturing plants, large format sheds, these sorts of things. Could be office, as in office space, retail, so shopping centres, these sorts of things, theme parks, logistics centres, all these sorts of different types of property. You might have a REIT that specialises in one. So you might have an office REIT, for example. So that's for investors that want to get access to the office market. Or it could be diversified. So really it allows, the structure allows you to sort of have diversified exposure to the property market, for instance. High value sort of commercial properties tend to drive most of the return in income with relatively modest capital growth. That tends to be how these REIT style products work. So now, hopefully you can produce a little bit of capital growth, but I guess this yet again reminds us that assets typically either be predominantly income or predominantly growth, and you can't expect an asset. In fact, there's very few assets, or none that I can really think of, asset classes that will deliver both. Whereas, don't forget, within residential property, there's some cohorts out there that will, and even with commercial property, that will try and suggest that you can actually get, high growth, 6 or 7% growth, and 6 or 7% yield. In reality, in markets, it doesn't really work like that. Just like with private investors, like you and I invest in the property market, REITs also use gearing to enhance returns, but the gearing levels tend to be much more conservative. As I said at the beginning, when we invest in residential property, most of us are typically borrowing the full cost of that asset. With REITs, however, the gearing rate tends to be around 30 to 40%. Because remember, the fund, it can't crystallize an income loss like we can. If we're individual investors, it needs to cover its interest bill. The major advantage is liquidity. Because REITs are traded on the ASX, as long as there's enough market depth, that the fund's large enough and it's a good quality asset, you will probably find it's pretty liquid. Now, it's possible that these REITs can stop trading or that they can hold on redemptions and so forth. This is less likely in ETF version of REITs, but certainly that can happen with direct REITs. So that is, if I'm investing in a particular actively managed REIT and it wants to stop redemptions or it doesn't have liquidity, it can potentially curtail those redemptions. Investors can obviously get exposure to ETF REITs. So you can, Vanguard will have an Australian REIT ETF and it will have an international REIT ETF, which I'll talk about in a second. And that just gives you access to obviously a broad basket of REITs. And I'll talk about, how they track, active versus passive within REITs themselves, because I've spoken about that previously with shares in terms of active managers fail to beat the index. Around about 70 to 80% of active fund managers fail to beat the index in the share market. Actually, the performance is worse when it comes to REITs. And that just means that if you want access to REITs, probably ETFs is the best way to get to that. Okay, let's talk about some of the common criticisms with REITs. And let's start with control, because I think control is kind of one of the big things that attract investors to direct residential property, or let's say direct residential and commercial property. And so we need to really make friends with the fact that we don't have any control. And sometimes people are attracted to property and dissuaded from investing in shares because of this control element, which I don't necessarily subscribe to. I think it's an emotional, certainly I acknowledge it's an emotional decision, but I think what I would suggest there is you should never let your emotions unduly influence your investment decisions. So I think we need to separate what is a fundamental concern versus an emotional concern. Now, one of the things that I've heard commonly through the property industry is with these REITs sort of products, what they'll do is they'll employ acquisition managers. And so their job is to go out and find deals, find properties to buy, find, properties where we can invest the money and so forth. And quite often these are sort of, property style people in a sales role, of course, that need to put a deal together. Now, of course, there needs to be, or you would expect that in most businesses, they're going to have certain hurdles that need to be achieved in terms of quality and quantitative and qualitative metrics. Like they're not going to buy any property. It's got to look like a good deal. You would think that's true, right? But the thing is that these people that are in the acquisition phase might go out and buy a whole bunch of property. The thing is they don't have any skin in the game. They might, once they've bought these assets, they might get rewarded by a large bonus. And then 1 year later, they've found employment somewhere else. So they're not hanging around to deal with the consequences of those decisions. Now, I know that's a really skeptical view, and I'm sure, funds have really strict acquisition criteria in place. But from my perspective, you want to make sure that, I've often said, you don't want to take advice from someone that doesn't have to live with the consequences. So again, this can be a challenge that you don't have control in which assets they buy, which assets they sell. You are along for the ride. And so your returns will be certainly linked to the quality of those decisions. So lack of control is an issue. The next common criticism is volatility. Again, one of the attractions to property is that most people sort of see it as a safe asset or a safer asset. And it's true. Property, particularly Australian residential property, for example, I'll speak about that because that's the one I study the most, has about half the rate of volatility than the share market does. And there's lots of reasons for that. It's illiquid. You can't trade it as often. You've got very high entry and exit costs. That also reduces the volatility in terms of people selling and buying. Whereas with the share market, a click of a button, you can sell some shares and react to data if you want to. The reaction time is somewhat muted with respect to property, except the long-term data with REITs is actually not in its favor. So when we look at the US index, for example, over the past 20 years, the annualized volatility is around 21%, whereas in the share market, it's been 15 to 16%. Now, 15 to 16% in the share market, you might argue is kind of on the low side. Typically, what you would expect in a share market is somewhere between 15 and 20%. But But certainly the volatility in REITs, in US REIT indexes, is over 21%. So it's over that 20% upper end for shares. And in Australia, very similar sort of results. Annualized volatility for REITs is sort of low to mid 20% versus mid-teens for the ASX 200 index. So on a pure volatility basis, actually REITs seem like a riskier asset. Now, this, I think, suggests that it's not really going to do what you want it to do. If you want diversification, I think you want to invest in assets that are either negatively correlated, so that when one goes down, the other one goes up, or you want assets with completely different attributes. But if these assets are just going to behave like each other, then you're not really getting much in the way of diversification. Well, but the proof is in the pudding. Well, actually, the proof is in the eating, not in the pudding. So let's think about returns and have a look at how have REITs performed over the last period of time. So what returns can you expect if you're going to invest in REITs versus the share market versus direct property? So if we start and look at the two major ETFs, I mean, there's a few REIT ETFs on the ASX, but I'm going to look at Vanguard's. And the reason for that is they've been around the longest. And so if you look at VAP, which is Vanguard Australian Property ETF, it's delivered pretty strong returns over the last 15 years. So because this ETF began in 2010, so we've got 15 years of data. It's been about 10.2%, and that's consisted of about 5.3% of income and about 4.9% of capital growth. Now, you'd look at that, I would look at it and go, that's a really great quality return. However, we've got to be really cognizant of the concentration within the index. Goodman Group, which is just one stock, makes up 35% of the index, and the top 10 holdings make up 85% of the index. So what you need to be concerned with is that Goodman Group has returned some significant, its share price is up around 15 times over the last 20 years or so. I think I'll get to that in a second. Up 15 times since 2009, in fact. So 35% in Goodman Group. Okay, so the index is shooting the lights out, but we've got a lot of concentration risk. Now, why is this important? Because it bucks the trend of indexing. The whole idea behind indexing is I get broad-based diversification across a whole geographical market, and where indexing doesn't work as well as where that's not true. And which I'll get to the results in terms of index versus active in a second, but we just want to be cautious around what the returns are. Now, that's the last 15 years. If you look since inception, it started in 2002, so about 18 years ago. Oh, no, sorry, it's about 23 years ago, sorry. Its returns are about 6.9% in total. So that looks a little bit more modest than the 10% over the last 15 years, thanks mostly to Goodman Group. Now, if we cast our eye a little bit further afield to the international index, so Vanguard's International Property Index, I don't think it comes in an ETF format. I think it's only in a managed fund format. Anyway, since it launched in 2005, it's returned only 5.25%, with about 4.9% in income and less than 0.5% in growth. Now, this you'd expect to probably see a little bit more growth than this because it hasn't even kept up with inflation. But these types of assets, as in REITs, should be predominantly income style assets. So we shouldn't be surprised by that. Now, before COVID, because obviously since COVID, REITs have been smashed a little bit, mainly because they were caught out with very significant interest rate increases. Remember, most central banks in 2021 were saying rates aren't going to change for a long time. Well, that really upset REITs. So even if you take out that COVID period, so we'll look at 2005 to 2020, for example, the return since inception was about 6.6%. 5.1% income, so still very similar sort of income, 1.5% growth. So that's getting somewhere closer to kind of the results that you would expect, but it's hardly compelling, right? Those returns aren't that attractive. When you look at the SPIVA data, which is the data produced by S&P 500, which benchmarks active managers compared to the index, over the last 10 to 20 years, 82 to 90% of active fund managers failed to beat the index. So therefore, this tells us index investing with respect to REITs is the best way to go. And that's why when I'm looking at Vanguard, both funds have been around for a long time and they should give us I I think, sensible idea of what returns we can expect. So the international index, though, is far more diversified than the Australian index. It's got 300 holdings. The top 10% represent about 39% of the index. Remember, in Australia, it's about 85% and has a lot more geographical diversification, although 70% of it is in the US market. And my understanding is the US office market is certainly struggling. So unlike the Australian index, which remember, 35% is invested in Goodman Group, which has seen a five-fold increase since 2009. The international index isn't like that. Look, I think realistically, if you're going to invest in REITs, based on this analysis, you can probably expect somewhere between 6 to 8% in income. So I think when we look at the past returns, particularly in the international sector, we've seen, a normal level of income, but probably an abnormally low level of growth. You probably can expect a little bit more growth than that, but not a lot more growth. Now, let's compare that to residential property. And we have to do that really at a sort of a pre-gearing level. To look at the combination. So what I've done is looked at, how house prices have changed over the last 20 or 30 years. And I did that in a previous blog where I looked at really back to the past 40 plus years. And over the past 20 or 30 years, we've typically seen growth range from 5.5 to 6.5%. And investment grade assets tend to deliver around sort of 2.5 to 3% in rental yield. But of course, we've got some expenses associated with that, property maintenance, management, insurance, council rates, all those sorts of things. So if we allow 35% of gross rental income for that, we're looking at a net rental yield of, say, 1.6 to 2%. Now, I like to be conservative with these numbers, but conservatively, that's what we're looking at. So we're really looking at a gross return of about 7 to 8.5% if you look at the capital growth plus income. Now, again, it's conservative, hopefully by applying sort of sound evidence-based selection principles, which I've spoken about in terms of scarcity, high land value component, and an asset that has strong evidence of past performance. Hopefully you can outperform those numbers and you can derive a return of 8 to 10%. But again, if I'm being conservative, I'm looking at the sort of lower end of the numbers. So let's bring that all together then, because hopefully what we're trying to do with REITs, or the idea behind it, is you want to get access to an asset class that is property. You hope to enjoy a consistent level of income from that property, which is true net of the relatively low level of gearing inside REITs. And hopefully when you invest in an asset that has higher volatility, in the long run, you should earn better returns. Remember, direct residential property volatility is about 10%. The REIT indexes are around 20%, so twice as much volatility. You want to be compensated for that higher volatility. You want to be compensated for that high risk, and it really doesn't look like you are. So by comparison, if we compare REITs to direct property, you've got no control with REITs. You've got full control with direct property. With REITs, you've got full liquidity. You can have the cash in just a few days by selling the ETF, versus it'll take probably roughly 6 months to get some liquidity through direct property. A lot lower gearing in REITs, 30 to 40%, where you've got about 100% or potentially up to or more than 100% gearing with direct property. And that could be, an attractive proposition for those that really want gearing. That is, people that are younger that are looking to build their asset base. Volatility, as I said, more than twice the volatility, 20% for REITs, 10% for property. Net income is a lot better for REITs, so about 5% versus less than 2% for direct property. Management time, of course, REITs are completely hassle-free. They're not going to take any time to manage, whereas property can be time-consuming. And when you look at the long-term returns, 6 to 8% for REITs is reasonable, roughly 8% for direct property. Of course, that's an 8%. That's a gross return off the asset. But once you add gearing in there, that obviously magnifies that return. So I think they're different assets for different jobs. That's the way I would look at, when comparing property. I wouldn't really regard it as a property asset per se. Yes, you get exposure to that market, but it's not behaving like we would expect a traditional property asset to behave. You're going to have, higher volatility from year to year, even though the income return expectations are pretty predictable. That is, you can probably expect to earn 5% per annum from REITs. And whilst the value of that investment might rise or fall, the level of income that you're getting from the portfolio should be pretty predictable. So REITs might work really well in low interest rate environments, or work better in low interest rate environments when bonds aren't delivering a lot of returns, bonds and term deposits and interest rate securities like that. When interest rates are low, they're not delivering a lot of income. So in that situation, people might turn their mind to REITs, although being careful that, the volatility is much higher. But in today's market, when high quality bonds are delivering kind of similar returns to REITs, my argument would be, why would you take the risk? If you want 5% in terms of income return, there's a much better way to get that net of volatility and risk than investing in REITs. By contrast, property is really a growth asset. It's not going to be an income style asset. Investors can borrow, 100% of the purchase cost, which is going to amplify returns even further. And it's really an asset and strategy that's going to suit someone that's looking to really build their asset base. Remember, I've previously spoken in this podcast that building wealth really requires kind of two steps or two shots. The first step is build your asset base. Then the second step is, once you've built your asset base, start tilting towards more income, more liquidity, less hassle, less cost, less risk, and that is lower borrowings, because you've already done the heavy lifting. So certainly if you're employing a gearing strategy with property, you should expect to generate, if you're doing it properly, double-digit returns. So net of that gearing argument, and I've got a link to that blog where I talk about why is it double-digit in the blog on the website, of course, which we will include. So in short, whilst REITs do invest in property, they are fundamentally different to direct residential property. And I think those two assets serve two very different roles, even though they've both got sort of property in the name. And I think that's why, we really need to dig a little bit deeper. Don't just trust the sort of general information out there. I always like to sort of test conventional wisdom and really look at the numbers and the evidence to really work out what's going to work, what is appropriate, and when it's appropriate to use those style assets. Okay, for those that are listening on YouTube, I'm going to leave it there. For those that continue to listen on the podcast, the audio podcast, I'm going to get into some Q&A. Okay, first question is from Chris. Chris writes, in episode 291, you stated that the income from shares within an informal trust is taxed at the trustee, i.e. parent's marginal tax rate, when using the parent's TFN, tax file number, when setting up the informal trust. And the shares can be transferred when the minor turns 18 years old with no capital gains tax event. I'm trying to understand if this is correct, since I've read from multiple sources online that in order to transfer the shares with no capital gains tax to the minor on their 18th birthday, the income from the shares will be taxed at the child's rates, which are higher, they are. That is, in order for the shares to be treated truly as the beneficiary, any income will be taxed at the beneficiary's tax rate, since it's technically their assets. Apologies if I've misunderstood you in the podcast, but clarity on the issue would be helpful. Okay, so what Chris is talking about is that you can, if you want to invest on behalf of your kids, of course, they're not 18, so they can't legally hold shares yet. So you can do that by using what's called a minor's trust account. So if you go to CommSec or most share brokers, I'll have minor accounts, which means that it's an informal trust, which means that there's no actual trust deed. But essentially what you're signifying is, I'm setting up this account, and the person that has beneficial entitlement to these assets is the child, and I'm just acting as the trustee. So me, the parent, the adult, I'm just the person that's legally holding these shares, but on behalf of the child, which is fully entitled to these assets. So that's the informal trust nature. Now, when you set up these accounts, you'll need to quote a TFN. You can either quote the child's TFN, but if they don't have one, then you quote the parent's TFN. So essentially, you'll wear the tax burden for these shares for the time until they're 18. And what Chris is suggesting is that in order for these assets to transfer, we need to prove or demonstrate that actually the child's been paying tax on the income up until their 18th birthday to prove that they're actually their assets. Now, it's not true, Chris. Firstly, these assets are held on an informal trust, and the sole beneficiary that has absolute entitlement to these assets is the child. So nothing's changed. No ownership has changed. The ownership right from the get-go, regardless of where the income was taxed, was the child. And we know that because it's an informal trust account. So the very nature of the account. In trust law, how the ATO tax trusts whether it's the informal trust like one we're speaking about, or in fact like a family trust, is that if they can't tax a beneficiary, they'll tax the trustee. And so in this instance, where you've quoted the parent's TFN, what you're actually doing is you're wearing the tax burden not as the parent, but as the trustee, not as the owner of the assets, but as the trustee, the holder of those assets. And that's exactly what happens if you have a family trust, for example, that doesn't distribute all profit in a particular year. It will be deemed that the trustee will be taxed on that profit, and the trustee will pay 47% tax. 45 or 47, there's a little bit of a technicality here, but you'll end up paying tax at the highest marginal rate, which is the whole reason why people make a distribution each year to avoid that happening. So that's not true, and in fact I've executed this arrangement. So as you would imagine, eating my own cooking, my sons have owned shares for many years, which I forced them to invest in. And at the beginning of this year, they turned 18. I transferred those shares into their name, and I won't be paying capital gains tax, I can guarantee you. Anyway, that's how it works. I should say, just as a sidebar, and this is something you need to really think about, I use CommSec to invest my son's shares. I mean, when I started a long time ago, there weren't that many online brokers. There are a lot now. Now, to do an off-market transfer, which is essentially what you're doing when you transfer into their name, the share platform provider will charge you a fee. I can't remember how much CommSec charged, maybe $50. But the thing is, if you end up having a portfolio with a whole bunch of ETFs, I mean, it wouldn't be difficult to build a portfolio of 10 or 15 ETFs over time, like if your kids are young. Just be conscious of that, because it means that you're going to have to pay 15 times $50 or whatever the fee is, right? And the fees can change over time. You might get into something that has nil fee, and then all of a sudden they introduce a fee. So what I ended up doing is I had a couple of smaller holdings that I had to, it just wasn't worth paying the fee. I sold those holdings. Now, me as their parent, I'm going to pay the capital gains tax on that, which won't be that much because we're not talking about sheep stations. But just interesting in terms of executing this strategy, the fees can really eat into it. And it's not something you consider when starting out, when you're setting up account for investing for kids. So anyway, I just wanted to mention it, not related to Chris's situation, but it's good to share these experiences, which is exactly why I do the Q&A and the podcast, is because after almost 25 years of doing this, I'm still learning things every day, sometimes through my own experiences or sometimes through my clients' experiences. But this is a great platform to share those experiences so others don't repeat the same dumb mistakes I have. Okay, I went a bit over today, so I might just leave it there. And next week, I'm going to talk about why, depending on your budget, if you're a property investor, and this is because, a lot more people, first-home buyers, so forth, and because property prices have risen so much in Brisbane and Adelaide, and to a lesser extent Perth. Melbourne's still relatively affordable, but because prices are much higher than they were, say, 5 or 10 years ago, I'm going to argue that if you can't afford a pure investment grade property, so that is if your budget really is under $1 million, you probably need to be an active property investor in order to, I guess, minimize risk and maximize returns. That's what I'm going to talk about next week. So I'm not going to give it all away today, but hopefully that's of interest. And until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.